Hello traders, Gary Wagner here. Approximately 11:30 in Honolulu, 5:30 in New York City. It is Friday, finally, the 10th day of August 2012, and this is the Daily Report, the Weekend Review. Nice week, nice finish to the week also. Mixed bag though, gold off of the highs, closed up around $3.5 higher. As you can see, current print forecast $619.80. The high was $1628.30 with a low of $1603. Silver did run into some resistance, closed predominantly unchanged, down a penny. As you can see, over $28, but just barely over 28 at 28.08. Low 27.51 and the high 28.49. Traders, this morning we published the latest edition of Chart This. It is a weekly show that I do with Kitco News. Sent you a link. We'll also include one in the email going out today. And really what we honed in on was by using a combination of technical indicators. It at times will give us great clarity in the market. And so really what I talked about was what we have been combining. You as subscribers have watched us do this for quite some time, but the Heikin-Ashi candles, MACD, Elliott Wave, Fibonacci, candlestick patterns, kind of putting those all together. And the interesting thing is, a rose by any other name smells like a rose. It smells as sweet. And a triangle breakout or compression triangle, which is what I call it, whether you want to call it a flag or a pennant. Simply put, this would be more a pennant than it would be a flag. It's hard to say if it would be a wedge. A wedge should be slanted down, kind of like this, but you never really get these flat bottoms like this. But irregardless of what you want to call it, I think that there is irrefutable evidence at this point that we are in some sort of a compression triangle, and that compression triangle, most importantly, if we follow the doctrine of Elliott Wave, is maintained with a 5-leg count. And that's what I am in a quandary about, because I really see, there's no doubt, we have 1 and 2, 3, but we've never really completed 4. As you can see, it never even came close to the upper resistance line that we have currently in gold. At the same time, we did find resistance, and it's quite honestly based upon a Fibonacci. Let me put that up. And as you can see, I've just compressed the chart so we could bring that in. But this 38% retracement level, 1525, that seems to have provided us initially a lot of support. Now, there's one other retracement we want to look at. And as you can see, I've added one more. And here's what you want to look at. This is a very, very long retracement sequence. It's going back to really the beginning of the run. As you can see, right around 2009. This is a shorter retracement. And this retracement, if we follow it up, is just probably August or September of 2010. And this is when the market hit, I think, over 1,200 and then came back down just above 1,100. Now it's, as you can see, 1148. Interestingly enough, when we plot these two, and we've talked about this before, this first one, this 38% level, there could be no doubt there's really strong support there, but resistance has continued to really hold its head right in this area, this 38%, which is of course a shorter sequence. The key is that right now it has been trading within this range, but it is my sense that we'll probably continue on this 5 count. I could be wrong. I have been before, but 1, 2, 3, 4, a fifth, and then our final thrust. Now, if that's the case, and we look at any kind of a time sequence on the bottom of this chart, October, November, we could be looking at a completion, an absolute completion, meaning we get the thrust anywhere between September October or November. I would think more towards October, but personally, I think that it will complete the entire 5 legs. Where we'll really be able to tell is if the market continues up, as I believe it will. I think it will slowly meander up at this point, but how will it react right at the thrust line, meaning the point in which it's going to break above this resistance right in here. If it simply bounces back, that's 4, and then we will get a 5th small leg down and a final thrust, and this is when we'll know about it. We are looking at a 420-minute continuous contract. This is of COMEX silver, as you can see, right above 28, 420 in terms of the Henkin size. And my daily subscribers know, because we've been talking about it all week, my sense was that we would probably hit some really strong resistance anywhere between 28.20 and call it 28.35, 40, right in that area. And as you can see, there is no doubt that over this time period right in here, this market maintained this as absolute resistance, could not break above it. I think that in terms of historical data, we've got a pair of tops right in here that kind of correspond to that. So I think that it's really going to be a strong level of resistance that silver needs to break through. I believe it will follow along with gold. So if gold continues higher, we should see silver continue higher. However, we have seen a small divergence where silver was leading the way a couple of weeks ago. It seems as though over the last few days in trading, we've had gold stronger and silver either slightly weaker or unchanged. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you on Monday for another update and review. By the way, we are having construction on the website. You've probably noticed by now it will be done by the weekend. And after the credits, I will include the small clip from the Kitco news article that will contain just the lesson. Have a great day. Bye-bye.
Off, left hand. Small board, left hand. Big board, right hand.
But I'm almost done.
I think you're going to find today's session quite interesting. What I want to do is kind of go over very, very briefly the topics we've already covered as we look at gold. And then I want to incorporate a couple of Western technical indicators. One, MACD, simple moving average convergence divergence, and then what I consider to be probably one of the more difficult techniques to learn, but I believe one that offers incredible insight, and that is Elliott Wave. Weekly chart in gold, and there's a couple of things that become very, very evident when we look at this market. We talked about the channel lines, the trends that took this market to these record tops. We looked at the actual retracement level as one that was a 38% retracement level, and we talked about the fact that with these Henkin Ashi candles, you get a real clear indication of current trend and strength of that trend. Obviously, very, very strong. And what we have noticed lately is that we have had a series of lower highs, a flat bottom, and that's really forming what's called a pennant or triangle formation. You can also see that the Henkin Ashi candles have gotten very, very small, and they're kind of alternating between green and red. There's no real clear defined trend as of yet. But there's a couple of indicators, a couple of things right now that are pointing to a potential bottom in the market. First one is moving average convergence divergence. It is an excellent, excellent study to incorporate with Henkin candles. Why? Because typically what you'll see is that when you reach these pivot points, you'll go from green to red. At the same time, you'll notice that the MACD tends to cross right at that area. Now, I have set my moving average convergence divergence to 12, 26, and 9. You can also see that as the market comes down, you get a sense of a buy, but that quickly fades as it moves back into a sell. That's this. And right now, what are we looking at? Well, we are looking at the fact that on a weekly chart, the moving average convergence divergence appears as though it's about to cross. Absolutely, the market is very, very much oversold. And so that's the first indication that we really could be looking at a nice breakout to the upside. But the real indication comes when we add to this mix Elliott wave count. Looking at a weekly chart, this weekly chart is in Heikin-Ashi format. It does have the MACD, moving average convergence divergence. We are using Fibonacci, but we're going to introduce one last element right now, which is Elliott wave theory. Elliott wave theory is simply the idea that markets move in patterns and that those patterns tend to repeat themselves to a degree with variation over time. What you'll find is that as you get deeper and deeper into your study of technical analysis, the best indicators are ones which attempt to understand and translate, so to speak, market sentiment, to mathematically quantify how people feel about a market. Now, in essence, the way that Elliott wave works, and I'm only going to explain a bullish cycle, but the way that it's composed is each bullish cycle is composed of a total, of 5 waves, and then 3 waves. The first 5 waves are 1, 2, 3, 4, and 5. Where 1, 3, and 5 are what are called the impulse waves. And then the corrective waves, these down waves, are going to be 2 and 4. It's always going to be like that, but there'll be variations off of that. Then you go into what's called a simple correction, which is A, B, and then a C. So you have a total of 8 waves, 5 in the impulse section, 3 in the corrective stage, and as long as the bullish cycle continues, you will get a count like that. So this is what we call our long count right now that I'm working on in gold. And this long count, of course, starts back at, as you can see, this is 2008. The market comes down and completes a cycle right at the conclusion of 2008. So the count that I'm looking at, a long count, is 1, 2, 3, 4, and then we should have one last final 5th wave to complete this 5-wave series or section. To me, this is where it really gets interesting, when we put all of this information together. And what we're looking at is this. When we look at the current state in gold, and this, without a doubt, whether you want to call it a wedge or a compression triangle, Elliott wave has actually identified a pattern which he says appears as a 4th wave typically. And in that, rather than it having that classic, you go up to the top and then you get an A, B, and then C, it is a compression triangle. And according to Elliott wave, it is composed of 5 legs. Now, the way that the count would work is as follows. After hitting our record top, the market retraces, and this is the first leg. It's got to touch the bottom. Second leg. This, on my count, is the 3rd leg. We've had this failed 4th leg. And one of 2 things, in my opinion, are going to happen. Either the market will trade back up to this resistance here with one final leg, that 5th leg, and then we'll get what is called the thrust. The thrust, of course, is when price breaks out above this compression triangle. The other alternative is, because this has been so elongated, that a possible count could very well be 1, 2, 3, and then a break to the upside. Now, first thing. The second thing with Elliott wave is that the belief is that these three impulse waves, 1, 3, and 5, are going to be of about equal length in terms of price move, with 3 typically being the longest, but it cannot be the shortest. What I mean to say is that if we go into a major fifth wave, if that's correct, 3 to 4 will take us to what, this 1520. We will reach a new contract high on wave 5. And to me, that's an incredible, incredible thing to think about. Elliott Wave.
Show me sand floor. Sand floor. Sand floor. Big sucker, sand floor. Sand floor.